start with thanking a few people first. And first, I'd like to thank Burden LLP and Mayor Mintz for cooperating with us and partnering up with us for Coffee and Caprits this time and before as well. I want to extend a very warm welcome and thank you to our panelists, to Eitan Shlomovic, to Jim Simmons, and to Rick Gropper. And Mayor will moderate a panel with them a little bit later this morning. And I want to extend a welcome and thank you to James O'Neill, the Executive Director of Legal Outreach. Legal Outreach is one of the organizations that Ariel Property Advisors, Burden, and myself have been supporting for the past 15 years. It's been one of the wonders in New York City, in my opinion, with regards to helping underserved communities and kids, students, get to better schools. James and his team have been doing it for a few decades. And in a second, I'll let James talk a little bit more about what they're doing now, how they're dealing with COVID-19, and what is their goal moving forward. So James, thank you for being here. In terms of our company, for those of you who are not super familiar with us, we're a real estate investment services company that focuses and sits in New York City. We have three divisions. The first one is investment sales, where each one of our brokers focuses on a specific sub-market and gets to be an expert in that market, provide a tremendous flow of information to our clients. The second division is our capital services division, where we produce debt and equity solutions for our clients. And the third is our investment research division. Many of our reports come from that division. All of our reports come from that division, as well as asset evaluations that we do for our clients. The presentation you're going to see this morning is a result of that. It's going to be available to you, and we're happy to answer any questions you have after the presentation as well. Before we continue with a professional and market overview, we're going to ask James to please join us and have a few words. James, the floor is yours.
Thank you so much, Shimon. Good morning, everyone. So first of all, I'd like to thank Ariel Property Advisors and Burden, the sponsors of today's Coffee and Cap Rates event, for their support of legal outreach, especially during these challenging times. Organizations like these two, led by Shimon Shkury and Mayor Mintz, the moderator of today's panel, make powerful statements when they support nonprofits like legal outreach, especially in the midst of an economic crisis and pandemic. Make no mistake about it, though all of us have been affected, some have been affected more than others, and it is the students and families supported by legal outreach that have been impacted the most. In a survey we administered at the apex of the pandemic, 58% of our students reported that a parent had lost a job. Think about that, 58%. And 28% reported that a parent was an essential worker. That's almost 90% of our kids. A number of our students also reported that a family member had already contracted the virus. And actually, we had at least 2 students who had a parent who passed away. Fortunately, measures were taken by Congress to sort of help tie some of these families over when they lost their jobs. But as we all know, there's bound to be a reckoning at the end of July and August if Congress doesn't act again. August is the very time when members of our senior class are due to matriculate to college. We're seeking to support them by raising funds through an emergency relief fundraiser so that their dreams of a college education are not deferred. These are students who live in the communities in which many of you invest and who, for the most part, will be the first in their families to attend college. For those of us who believe that education is still the way out of poverty, our students need your help. When you give, you're supporting social justice in one of its most productive forms. For those of you who would like to support our students, we're asking you to make a donation through the link on the chat. You need to copy that link and place it in your browser. The amount you give isn't as important to us as everybody giving at least something. Any and all donations will help ensure that our students don't lose hope or miss out on this life-changing opportunity during these trying times. If you don't make the donation now, it's easy enough to do it later just by going to our website at legaloutreach.org. For those who want to support our students who are still in high school, you can do so by participating in our professional exposure program known as PEP. All it takes is an hour of your time where you would have the opportunity to expose our students virtually to your specialty in the real estate industry. If you're interested, please contact Tamika Edwards, whose information is listed on the screen here. She'll contact you and we'll take it from there. It's a very easy way to be a part of the process of changing kids' lives. So finally, again, just want to thank Ariel Property Advisors. I want to thank Burden, and I want to thank all of you for supporting our kids and for being advocates of education and educational opportunities. Thanks so much, Shimon.
Thank you so much, James. I can attest that we've seen firsthand kids that benefit from the program. If you believe in education as a means to improve lives, this is the organization that you should definitely invest in, and we'd appreciate it if you'd consider a contribution. Burden and Ariel are going to do so right after this session. So thank you, James, for being with us, and thank you for sharing your nonprofit with us. So the agenda today is some discussion about the current state of the market, a very high level, and then I'm going to hand it over to Mayor to take over the panels and discuss it with our guests. The first half of 2020, as expected, has been extremely low in terms of volume of transactions. We've seen close to a 50% decline in terms of dollar volume. The second quarter is what really affected it. $2.13 billion, a 70% decrease compared to the first quarter. That's something that we've anticipated. We know that this is probably the lowest quarter over the past decade. And if you look at the graph, you can see that. We want to tell that Q3 is probably going to be as low, if not a little bit lower. See, the second quarter had closings that took place mostly prior to COVID-19. So the closings that took place in quarter two are closings where contract went prior to the epidemic. And we've seen some contract signing throughout the past few months, but not enough to justify a higher volume. So expect a slower, or at least the same quarter in quarter three, and hopefully some kind of recovery by the end of the year. On a positive note, and looking at the long-term longevity of New York City, we thought of looking back for the past decade and seeing how many positive aspects took place as it pertains to real estate. And I'm not going to list them one by one. This slide is going to be available to you. But if you look from 2010 to 2018, there's been a dramatic improvement in an already well-to-do city. And we believe that's going to positively contribute to the well-being of the city long-term. Let's review the asset classes during COVID-19. We'll start with hotels. In April, we've seen occupancy rates drop to 20% at best, and this has been better over the past few months. We're told occupancy rates are closer to 50%. It's far from being sufficient to have hotels operate as businesses. There are about 25,000 rooms that might not come back online. It tells us that the hotel asset class might need some structural change, and some use change possibly moving forward. Retail. Retail has been suffering pre-pandemic. Collections in April dropped dramatically. And now the issue is not just collections, but it's about vacancy. As New York City entered phase 4, retail stores, some of them started to open. You can see restaurants and customers sitting outside. The question is it enough business to support the prior rent? We know that landlords and retail tenants are currently restructuring leases and trying to make sure that the tenants stay and can flourish, because there's not a tremendous amount of velocity in the retail tenancy world today. Office, similar to retail, we've seen collections drop in April, but collections improved as businesses received some government assistance in the form of PPP, and some of this assistance was encouraged to be directed to rent payments. Vacancy is on the rise. Smaller businesses and generally businesses that have a lease that's expiring in the next 12 months, definitely thinking twice about renewing, if at all. And many negotiations between landlords and tenants have been taking place and will take place. So we expect the office market to experience higher vacancy in the short and midterm, and experience pressure on leasing prices in the midterm as well. The multifamily market, we look at it in 3 different dimensions. We look at free market units, we look at rent stabilized units, and at affordable housing. When it comes to free market units, collections are not an issue. If you live in an apartment in a free market unit, you probably pay your rent. The issue is vacancies. So we've seen some tenants who have options to live outside the city, leaving the leases behind, and that creates real vacancy for multifamily free market units and owners, which will be translated into concessions in the short term. But free market units, from our experience, is also the first to bounce back when everything goes back to normal. So definitely an asset class to watch for. Rent stabilized unit multifamily is a little different. Here it's the opposite. Nobody wants to leave a rent stabilized unit, so the vacancy is relatively low, and collections are lower as well, comparatively speaking. It's not 100% clear. People say it's between 50 to 75%. We hear it's between 70 to 80% mostly. And remember that some government assistance in the form of checks or in the form of federal weekly unemployment could have contributed to a better collection rate. So we need to really monitor this asset class moving forward. Project-based Section 8 and affordable has been doing well, as collections is not an issue. The multifamily asset class pricings have gone down over the past year, not just because of COVID-19, mostly because of the Housing Act of 2019 took effect. If you can see here, mostly in Manhattan below 96th Street, average prices per foot dropped below 800 for the first time in many years. Brooklyn followed suit, Queens, Upper Manhattan, and the Bronx as well. So definitely short-term pressure on pricing, which will prevail moving forward on multifamily. The development market has been slowing down since 2016, with dollar volume only at $1.7 billion for the first half of 2019. We can tell you that we see pressure on pricing. This is going to be one of these opportunities to buy land at a less expensive price during this cycle in some locations that you could never get property for lower prices, or prices that justify residential rental development. So we're definitely seeing more of that and pressure on pricing on land. Also more joint venture opportunities as well as ground leases, something that is very characteristic for this time in the cycle for development. Industrial and warehouses are doing well. Logistics centers are doing extremely well with vacancy rates falling to 4.8%. That's from the get-go. And that's one bright spot and something that will continue moving forward. The lending environment has been accommodating. The Federal Reserve put interest rates essentially at zero and claims that's going to stay until 2022. Lenders are selective but aggressive if they find the right sponsor, the right product type, and the certainty of collections. Most lenders are requiring reserves, 6 to 12 months of principal, interest, and some taxes. CMBS lenders stopped lending at the beginning of the pandemic and came back shortly after in May. So there's definitely a lot of debt out there, as well as equity capital for the right deals and the right sponsors. On a macro, we've seen the government doing a lot to make sure the economy keeps going. The CARES Act that supported many smaller businesses, buying commercial paper, backing Fannie and Freddie Mac, allowed the stock market to climb back up very quickly. You have the chart here that shows you where we were in March and where we are today. Reopening the economy helped consumer spending go up. Virtually no consumer spending or drop in consumer spending in March and April, and consistent climbing up in May and moving forward, definitely encouraging economic results. The presidential elections is something that we should watch for. If you remember 2016, we had a pause right after the elections in transactions, something that we can anticipate happening here as well. One of the things we wanted to bring out is how real estate investment trusts or publicly traded real estate companies are behave from an investor's perspective. And if you look at the office REITs in New York City, they got hit hard. And that can tell a little bit of a story, not a full story, about how investors are looking at pricing of office buildings today. In terms of residential, if you look at EQR and Avalon Bay, for example, their stocks also got hit and climbed back up, not all the way, but somewhat back up. Again, tells us a story about investors' anticipation for short and mid-term vacancy and valuations of these assets. I think that it's completely different than looking at private assets, but it does tell us a little anecdote. On a micro perspective, New York City enters into phase 4. The schools are starting to open. I'm personally very happy about having my kids in school starting September 5 days a week. But I'm sure that the landlords are happy that Columbia, NYU, Fordham, and CUNY are opening up. And we're seeing this in the form of applications that are coming into free market units. We have a few buildings that we're selling right now that are receiving this benefit, and that's definitely a positive sign in the right direction. The political environment, not a secret, is something that's on investors' mind. Many of the investors that suffered losses out of the Housing Act of last year, not sure they want to continue to invest in New York City, and the mayoral and governor elections of next year are something to watch for and pay close attention to. In conclusion, we're looking at the world as a short-term, mid-term, and long-term world. The short-term, the next 12 months, rising cap rates, downward pressure on pricing, not a secret, higher vacancy rates. The bright spots are warehouses and industrial, as well as affordable housing. Mid-term really depends on how you want to define it, but we want to see someone come out there and say, there is a permanent solution, and that solution is going to be in effect in 6 months or in 12 months, and that means that we know we're going back to normal. So until that, we're in midterm. And we're looking for, in that midterm, we're looking for pricing discovery, which will lead to more transactions, not close to where we were a year or two ago, but definitely pricing discovery will definitely help us have more transactions moving forward. Long term, we believe New York City will come out of this stronger as residential rentals, specifically on free market, are going to be a lot more affordable, We'll allow the tenants that left to come back and pay less. Same situation with the office market, where businesses can come back to market and sign leases, longer term leases for much less expensive pricing long term. This is our conclusion, and that concludes my high level overview of what we're seeing in the market today. I want to thank you for listening, and I want to hand it over to Mayor Mintz to moderate our esteemed panel. Thank you.
Thanks a lot, Shimon. Great presentation. I see a lot of the topics that we're going to talk about are some of the stuff that hopefully you already mentioned. But before we start the presentation, why don't I just allow the panelists to introduce themselves? Eitan, you want to take it away first?
Sure. Thank you. Thank you, Shimon, for having us today, and Mayor for moderating. My name's Eitan Slomovic. I'm the Managing Director of Investments at Castellan Real Estate Partners. We are owner-operators of multifamily and retail, primarily in New York City. We also are bridge lenders and do about $200 to $300 million of that business a year across the U.S.
Jim? Oh, you're on mute. Jim, you're on mute. There we go. There we go.
Good morning. Thank you for the invitation, Shimon. I'm the CEO and managing partner of Ascent Capital Partners. We are owners, private equity investors in multifamily and a value-add sense, primarily in the top 20 MSAs across the U.S.
And Rick?
Hi, I'm Rick Gropper, principal of Camber Property Group. We started in 2016. We primarily engage in the affordable space, and we buy existing buildings, convert them to affordable housing, and also build new buildings.
Okay, and let me just give you a quick introduction. I'm Mayor Mintz from Burden. Burden's a top accounting firm in Manhattan, highly specialized in real estate. I'm actually an attorney and an LLM in tax, and therefore I'm heavily involved in a lot of the transactional work in addition to the routine tax and accounting stuff. Thank you guys for joining us. I guess just to start off, Shimon did a whole presentation about the market and where we are today. What do you guys see going forward? I know we've seen a lot of people talk about a mass exodus from New York. We've had issues because of the rent regulations that just came out. People are concerned with rent collections. What are you guys seeing in the market? We'll start with Rick.
So we own about 6,500 units, like 99% is affordable housing. And within that affordable housing, some of it is project-based Section 8, where the government pays at least 70%, if not more, of the rent, and the tenant pays 30% of their household income towards rent. More generally, it's more like 80 to 85%. So that asset class, and I think affordable in general, where rents are heavily discounted to market, is and has been very stable. Our project-based Section 8 portfolio vacancy has been close to normal, like 98, 97%. Our affordable portfolio without any government assistance, but not vacancy, the collections have been like 97%. The rest of our affordable portfolio has not been doing as well, but still better than I think most. So we're at about like 88% on average. And then we have a couple market rate buildings, one of which we're bringing to market right now, which is like the worst time in history probably, to start leasing up units. And we're sort of like trying to figure out where that's going to land. We think that we're going to be giving at least 2 months concessions, 2 months free rent. And I think our face rent is discounted like about 5%. But I think people are definitely moving out of New York City short term, but I don't think it's something that's not going to be reversed. And just like the past recessions, 2008, I think the city will come back stronger than it was in a more robust financial position.
What about you, Jim? You seeing the same thing?
Yeah, to a large extent, I think that I tend to view the world in through two different lenses. The first of which is through the lens of an investor, buyer or seller. And I do think that there are those who would rather not invest in New York City at this point in time, mostly due to the Tenant Protection Act, less so because of COVID. But I do see that there are some institutional individuals who say, listen, we're going to take a pause on New York to see where things settle out. From a renter tenant perspective, I don't see there being much risk in a mass exodus or even a mild exodus. I think the people who have left are people who have the ability to leave, who tend to skew older and tend to skew much higher income, which is not really a space that we typically play in. And sometimes your worldview gets skewed by what your personal experiences are. But the 20-year-olds to 30-year-olds, they are not en masse decamping for the suburbs. To the extent that they have left, they're living with their parents, and more because of their parents' fear than their own fears. And they can't wait to get back to the city. So it's mostly their parents telling them to stay out here because it's not safe, as opposed to them saying that I don't want to live in the city and I'm afraid and this. So overall, I view it as an opportunity because the same things that I saw back, and I can go back in time to going back to the early 90s through 9/11, Superstorm Sandy, Great Recession. In each of those periods of time, you had a percentage of people who were saying, oh, everybody's going to leave the city. Some people did, but very few. But for those who did, you had many more people who wanted to backfill. So as prices have been depressed for however long they are and cap rates have expanded, we view that as an opportunity to buy and acquire assets. As long as you underwrite responsibly, we believe that we should be fine.
I guess, and speaking of underwriting responsibly, Tom, what do you guys see going forward? I guess you guys are looking also prospectively in terms of what do you see rent increases and actual occupancy? Are you underwriting a higher number?
So on our portfolio, on the multi side in New York, we've been collecting about 90%. The retail has definitely been a struggle. A lot of our retail tenants are behind on rent. The vacancy that we've experienced, which has definitely upticked, and I think it's a short-term issue, have been apartments that were rented to students specifically. So we own a few buildings around Columbia, a few around NYU, Lower East Side, and those assets, a lot of those apartments were leased to students. And in March, April, we definitely got an uptick in vacancy. But I think that's just short term, and I think once New York comes back to the culture that it offers, those units quickly get filled.
Yeah, I want to. You mind if I? Yeah, I want to add something. I know Greg and Stephen from the audience asked a couple of questions that are very related to this. So.
Yeah, that was my next question, Shimon. The rents, in terms of the rents, what do you see, Eric, Eitan, what do you see the rents going?
Well, right now we've been able to keep rents steady with concessions, the face rent steady with concessions. So we're definitely offering more free months than we used to be offering, where previously units would be, we'd have no free months of rent. Now we're probably at 2 months free of rent in order to fill those units quicker. We also want to fill those units quicker because, obviously the banks are tightening up a little bit. And if you have too much vacancy, it becomes a lender concern if they're regulated. So we are filling units, but we are offering a few months of concessions, but those rents aren't dropping too much because of the additional free months that we're offering.
Mm-hmm.
Well, I think what one of the things we're seeing is it depends on the landlord, but definitely concessions of 2 months. We're seeing that across the board for new units. What's interesting for me to see is that bigger landlords have a tremendous amount of information about their tenants, and some tenants don't want to move, but they do want to get a discount. So some of the landlords figured out what does it cost to, what is the cost to move out? Is it $300? Is it $500? What is the inconvenience, etc.? And they're trying to negotiate in a smart way with existing tenants. So you have two types. You have the tenants that are trying to take advantage. And if you have enough information, you can work with that and give them a smaller concession than you would otherwise. And you have the vacancies that you have to fill out. So that's one aspect of it. The other aspect is it's short-term, mid-term. I think part of the presentation was, long-term, when New York City's back, when you're going to go back to your office 4 to 5 days a week, you want to be in the city. And the city will offer you, for a short period of time, a lower rent. And so I think this is definitely short to mid-term, and the city will come back very strongly out of this.
So I guess, Rick, on your buildings that you guys have, are you guys seeing like people wanting to stay, and are you guys doing anything to proactively keep that sense of community and make sure people don't end up being like the only person left in the building?
Yeah, we've seen, in our affordable portfolio, renewals have been relatively consistent with pre-COVID. Just because the rents are already low, residents are paying no more than 30% of their income towards rent for the most part, and yeah, the rent is discounted to market already. So our renewals have been, and our vacancy has been low. Our collections have also gone down to some extent, and we're working with all of our tenants to enter into payment plans so that they can stay in their apartment and continue to pay rent, make some contribution towards rent. And that's part of a commitment that we made along with a bunch of other landlords who own affordable housing in New York City. Our market rate portfolio, including a building that we're leasing up now, we're anticipating just offering renewals at the current face rent, and giving a month free just to keep them in place. Give them a month free on a 13-month lease to keep them in place. Just because it's not worth it to us to have a ton of turnover, especially in this market when it's going to be very difficult to get people back in there. The building that we're leasing up now in Ridgewood, Queens, we're kind of just going to get through the next 12 months. And then at that point, we think that we'll be able to get through the next 12 months by offering 2 to 3 months free to move people into the building. Then when it comes time to renew, we'll probably offer, we'll go to the gross rent and probably offer some small concession. And we're kind of like just pretending this year doesn't exist. And next year, we think that we'll be in a position to hit our gross rents with minimal concessions. So gross to net, we don't think that there will be a huge delta once things really stabilize.
And are you sticking to a 13-month lease because you think in 13 months pricing will be higher, or you're offering people longer if they so desire?
We're offering people longer. We're also thinking about what leasing season we're getting into. So a 13 or 14-month lease at this point is actually not great for us, because at that point it gets you into like Thanksgiving. So we might, we're thinking even going to like an 18-month lease. To the extent that people moving into the building are interested in going out that far, keeping in mind the leasing season. So if we can get to the spring of 2022, I guess, then we think that, at that point we'll be through the worst of this. And fortunately in the deal, we've got long-term equity, and we have a construction loan that has a lot of term left on it. So we don't have like mezz or pref where we have a gun to our head.
Okay. And Jim, what are you guys also doing? Are you keeping tenants there by offering different amenities, or it's strictly pricing and free rent?
So like Rick, the largest part of our portfolio has some form of regulatory overlay or subsidy attached to it, such that the residents are pretty sticky, and the turnover is mostly based on life events as opposed to by choice, I'm going to leave here. And that's also a part of our business plan, which is we want to be the best option within a micro market, if you look top to bottom, from a living experience. So to the extent that our tenants are happy, they're not going to leave. I think the bigger issue is what's going to happen when the unemployment bonuses, the COVID unemployment bonuses end. So we've had very, very little degradation of collections compared to what I expected. We're in the mid 90s, okay, mid to high 90s, post COVID. However, I am positive that a large reason why that is because people have had the ability to pay based upon the increases in unemployment coverage. When that ends, that's when the rubber is going to meet the road, because people literally won't be able to pay. And then what are their options? We proactively, for those who couldn't pay, before anything was announced, did exactly what Rick said, which was we negotiated either forbearance agreements or long-term repayment agreements, which reduce their rent in the short term, but amortize it over the long term of a lease. Under our larger business model of having really, really good relationships with our tenancies, and to the extent those tenancies are organized, having really good relationships with tenant associations, so that we said, listen, we're all in this together, right? It's not a closed system. If you don't pay your rent, it's not just the owner that's not getting paid, but it's the porters, it's the supers, it's the entirety of the ecosystem of the building, the people who change the lights and pick up trash, and in the winter provide heat. So you're going to have a couple of things that's going to coincide. Number one, expenses are going to jump because we all go into the heating season. Number two, taxes were due, or will be due depending on sort of your situation. Last time I checked, you got to pay water and sewer. Last time I checked, you got to pay Con Ed. So to the extent that those benefits go away, the people who are now paying rent can't pay rent. And so you're going to see this squeeze. And my fear is for those buildings that are tenuous at best, so at a 1-1 coverage or 1-2 coverage, that's going to dip to sub 1.0, and you're going to see an increase in defaults and distress. And hopefully the system can withstand that shock. But we've been through it before, collectively, meaning the real estate industry, and you'll see the right sizing of those assets, meaning the deleveraging, and hopefully longer term capital, like Rick mentioned, where you're not under the pressure of being able to have to meet debt service on a high debt balance.
And I guess, Eitan, from your perspective on the debt service side, have you been working with people that you've been lending to kind of, I wouldn't say share the pain necessarily, but at least letting them hold over for a month or two to the extent collections are not there?
So we had one hotel that was struggling, so we did work with them for a few months, and they actually came current the end of the second quarter. So our collections for our debt portfolio, the end of the second quarter, were 100% actually. We've been very focused on low LTV, low rate in that space. So whereas a lot of the bridge lenders may be charging, 8, 9, 10%, we're at 7, 7.5. But we're also much lower on the capital stack on the leverage point. So we did have, one group that we did work with. In general, the banks have been working, with a lot of the borrowers and providing some relief. And I think some of the other debt funds, depending on the amount of equity left in the property, are working with some of their borrowers, especially on the retail and hotel loans that they have.
Mhm. And Shimon, I guess to the extent people are selling buildings now, how are they factoring in a lot of these issues, like the collection issues and the vacancy issues and the turnover issues? Are people just saying, well, we're throwing out what happened the last 6 months and we're going to go back to normal and then kind of adjust the cap rate?
No, so it's a great question. People that are out there buying today, for the most part, understand New York City pretty well. What we see that's interesting, the most active buyers today are buyers who want to reposition their portfolio. So for example, buyers that used to buy in Brooklyn or used to buy in the Bronx, coming into certain areas in Upper Manhattan or Manhattan in general. So you really see people moving towards more quality, what they perceive as more quality locations and more quality assets, people that reposition from being a rent stabilized owner to mostly free market owner and so on. In terms of projections, look, they're looking at the asset, and many of them understand the market and have buildings in the market. They're looking at the asset, they're looking at the current vacancy. They're definitely factoring, very similar to what Rick, Eitan, and Jim said, at least 2 months concessions at lower rents. But if you look at their cash flow models, you see that some of them are more optimistic than others. So some of them will tell you, listen, in 24 months, we're going to go back to where we were pre-COVID in terms of the numbers. And some of them will tell you it's going to take 36 months. But within that time frame, the belief is that once the pandemic ends, New York City, from a free market perspective, goes back to more or less to where it was. And that's, and clearly capitalization rates are higher than what they were a year ago or even 6 months ago. It's not a secret, and that's something that has been pushed on rent stabilized, and now is also as a result of the pandemic is also in prevailing in free market units. So there are buyers out there. They require a higher cap rate. They look carefully at their projections and the vacancies, and they adjust.
Mm-hmm. And I guess on that note, Rick, when you guys are looking at deals, are you taking into account this kind of stuff? How are you looking at the buys?
Definitely. So we're still buying buildings. Maybe that's stupid, but we're doing it. And we're buying, to the extent we can get our hands on them, project-based Section 8 buildings, because there really is not any value impairment, or there's minimal value impairment because of COVID, where you have a contract with the government that pays the majority of rent. And even if a tenant loses their job, the HUD contract kicks in 100% of the rent. So those are very stable. And I think going forward, they're going to be even in even a greater demand. So we're buying a few of those buildings. And then we're also looking to buy existing affordable, where again, there's a heavy discount to rent, and the tenants are already paying a relatively low percentage of their household income to rent. So if they experience a salary reduction, or if they're in a service industry and hours get cut, the thought is that they can still still afford to pay at least something towards rent. We're looking at, there's in a couple of cases we have come across buildings that were on the market pre-COVID, and we were looking to buy those buildings. And now on those, the prices come down significantly. The collections are also down significantly, but we're talking about like a 20% to 25% reduction in price. And that's necessary in order to get in at a cap rate that justifies the acquisition at this point in time. And I think one thing that helps all of this and kind of like covers a lot of mistakes for people is the debt markets, and the fact that debt is so cheap right now. So you can get positive leverage on when you're even going in at like a 4 or 4.5 cap or something, although that's not where we want to be, but it helps kind of like deal with some of the collection issues and other issues that people are experiencing.
Mm-hmm. And Jim, I guess when you look at your portfolio and what you guys are looking at, what asset classes and what areas do you think you would look more at than others?
Yeah, so we are multi-specialist with an amount of retail and mixed use mixed in. You know, retail is the second shortest midget in the circus behind hospitality. So, you know, it's not something that we're hanging our hat on right now, other than grocery anchor, because necessity shopping still has to exist, right? And in the neighborhoods in which we own, a lot of people don't have the ability to order fresh direct because they don't deliver or something like that. So they have to go to the local supermarket to buy their food. But in the multifamily space specifically, I'll follow what Rick said, which is over the past, call it, well, long period of time before Tenant Protection Act, you had very low cap rates, very high dollar per square foot valuations, and even higher expectations in the minds of sellers, right? So it was really hard to get a deal done because what we could pay based upon our quote unquote responsible underwriting and what they wanted us to pay, there was a gap. That gap has diminished, if not closed, because there are a subset of people who are saying life is too short. Given the political uncertainty, given how difficult it is to make quote unquote money or the money that I used to make, I'm out. And so the challenge is, let's just figure out what I'm willing to pay and what you're willing to sell. And what I'm willing to pay is predicated on the 36 months or longer that I think that it's going to take for the world to get back to some semblance of normalcy, number one. And number two, what the full effects of Tenant Protection Act will be, right, over time. Right, we know what the immediate effects are, but how does that play itself out over time, particularly for those buildings that are partially rent stable and partially market, right? And can we, by dint of what we do things a little bit better than prior ownership? So part of what we're seeing is you may have one building that's next to another building, or certainly in the same catchment area, where one building is collecting 85 to 87% and another one's collecting 55 to 65%. Same general demographics, but vastly different collections. And I posit that that's a lot of that is based upon a relationship of owner to tenant. And if you are a tenant and you say, well, I can pay, but I can't be evicted, so therefore I won't, that's different from I can't pay because I don't physically have the money. And I think that the gap between in large part, the 55% collected versus the 85 and 95% collected is based upon the people who can pay but just aren't. And can you figure out how you can compel those individuals to pay? And some of that is quality of life. Does the owner do what they say they're going to do? Are they actually managing the property well? Do they have a relationship with their tenants or not? And to the extent that we believe that we can do that and close that gap, which, you know, selfishly, I think that why we're at the top of that range in our collections is because of that. That presents opportunity for us to go in and acquire units today.
And Eitan, are you seeing the same thing with respect to relationships where like you underwrite deals for people that you perceive to have good relationships with tenants because of that collections, or are there other stuff that go into that too?
For us, pricing hasn't hit a point where, we primarily own a lot of rent stabilized free market housing in Manhattan and the boroughs. Pricing, we really kind of put our foot on the brake in 2016, 15. We stopped buying heavily for a little bit, and I think pricing's starting to come to those, hopefully to those levels where we're comfortable again. Because like Jim mentioned, the difference between kind of the ask and where the sellers were and the buyers were just wasn't making any sense. And now I think we're kind of coming to that point where we're going to be comfortable to jump back in, and definitely COVID's a factor, collections are a factor, but I think if you underwrite conservatively enough, obviously with higher cap rates involved and slower rent growth in the near term, I think what pricing could be become very interesting shortly as well.
Okay. And one of the things that we've been hearing a lot about, especially over the last few months, I guess if you look at everyone, I'm sitting in my dining room, everyone else is at home except for Rick, who either has a very good virtual background or is in the office. Are you guys doing anything, or are you seeing any differences in the way the assets are performing, whether the income or the expenses, because a lot of people are working from home? And do you expect this to be like a long-term thing? Eitan, you want to try to take that one?
Yeah, I don't think that's, we haven't really seen much on the expense side. Like I said earlier, a lot of our tenants who are students did, on the rent side did leave. The expense side, we haven't seen much of a difference. I don't think long-term this is a permanent issue. I think people return very quickly after there's a vaccine. People get comfortable and people want to pay for what New York has to offer, which is, things are open, there's culture, there's nightlife, et cetera. And I think without that, people don't want to spend $5,000 in rent to live, near NYU. So, on the expense side, I haven't seen it, although obviously, taxes still go up and water and sewer still goes up and all that. Legal, if tenants aren't paying, costs more than it used to a little bit. But other than that, I think, people start returning once things go back to normal.
And what about you, Jim? Are you seeing the same thing where you're expecting people just to go back to normal as soon as everyone can go back to the office?
I think that it largely will. The benefits of being in one place and the interchange of ideas and information is definitely something that's important in a fully functioning organization. I know that probably each of us are making those types of decisions with our own businesses when we're going to go fully back in an office environment, whether we're going to have policies which allow people to work from home more or not. I do think that there is a shift in mindset. So if you go back a few years ago, working from home was viewed as a negative as opposed to a positive, right? Someone who said, hey, I want to split my time between the office and home had some negative connotations associated with it, rightly or wrongly. And I think that the benefit of where we are today is that those negative connotations have been melted away, number one. And number two, I think that firms are finding that productivity has not only stayed the same, but in some instances, or many instances, has increased. Mm-hmm. And if I look at my own personal situation, I don't spend time getting from the office to from my house to the office. I don't spend time getting from my office to meetings or to lunches. That has increased the productivity in terms of person hours that I spend working. Now, that may be a bad thing, but overall, the throughput of work that my team is generating has increased. The flip side of that is we can't do the other part of our business, which is important, which is kick the tires of buildings, do property tours, have face-to-face meetings with other parts of the ecosystem like lenders and appraisers and lawyers and the like. So I think that we'll see some modified world coming back where working from home will be a part of what people do, more so than it was before. which will in turn affect the office market because the square footage that firms are going to need will probably decrease, and certainly it will affect the temp office or the shared office, the WeWorks of the world. That will affect sort of overall office market and how people move around the city. But I go back to my real statement. I think that New York City, in terms of real estate, is still going to be very investable. It's still going to have a high amount of demand. People are going to live there, work there, and play there. So I don't see there being a big change other than how people work daily.
What about you, Rick? I know you're in the office. I can't tell if no one's with you or if they're just off camera, but are you finding a lot more people are working from home and they want to keep this as a permanent amenity, or is this something that you think is just going to come back?
I think it'll come back, but I think people, like employers, are going to be flexible in terms of work from home. When this all first started and everyone started working from home, I'm in the office like pretty much by myself. There are a couple of people here. We all have commutes that are just a couple blocks. So I've been coming into the office from the beginning because I get distracted at home and like end up not doing anything, like watching something dumb on TV. So I come into the office. And the first like month I was like, where the fuck is everyone? Like, what's everyone doing? But then I realized that people are actually pretty productive at home and cut out, like Jim said, cut out a lot of travel time. There are no meetings. There are no face-to-face meetings happening right now, or very limited number of meetings. So that like you get a lot of time back on that. So I think like I'm a lot more comfortable with people working from wherever because it seems like it's actually like going pretty well and that people are happy. So I think we're in phase whatever 4 or something in New York City, but we still don't have a whole lot of people in the office, and we're giving our team the flexibility to come in or not come in. And I think we'll see how it goes. So I imagine that there will be a long-term positive effect on the way people work and interact and use offices or don't use offices. The full effect won't be known for a long time, but I don't think it's just a short-term thing. I think in a good way, it'll probably change the office environment.
Do you see people wanting like extra bedrooms now because they expect to be working from home longer, or is that too soon to tell?
We see the share market as like pretty dead. So we have some buildings where we lease apartments to like 2 or 3 or 4 roommates, and I think a lot of those people have actually like moved back with their parents or go wherever they're going. They're younger people for the most part. So I think there's less interest in sharing a small space with multiple people, and more interest in having space and less density. So like we have a project in Ridgewood, Queens, which is right on the border of Ridgewood and Bushwick. And pre-COVID, our marketing was geared towards Bushwick. So like live in Bushwick, go to all the cool bars and restaurants and hang out with like the artists and restaurant, like service industry workers, bartenders, hang out with all those people. And now we're more like live in Ridgewood, you have more space, like de-densify your life. So I think that kind of like thinking along those lines is going to be more prevalent, at least in the short term, if not like longer term, where people realize that they don't have to be like in Manhattan somewhere. They can move, get some more space, have some more outdoor space and less density.
I mean, listen, we're an accounting firm, so we do have a lot of employees. We're seeing similar things where people do want to work from home. We've been a little more flexible, but we've been speaking to a lot of our clients too, and they say a lot of the junior people are really losing out on that hand-holding and that demonstrating how to do modeling and how to do numbers and how to do a lot of the projects. I forget who it was who told me, like one of the big, I forget it was a brokerage firm or one of the big companies were saying how like a lot of the models they're afraid of flawed because the people just don't have people over their shoulder explaining to them how to do them properly. So, I mean, I do think it is going to be here to stay in a smaller scale, but I do think that, like everyone is saying, people do want to come back to the office, see faces again, interact with people. Thank you to the panelists. Thank you guys all for coming. Shimon, were there any questions that you wanted to address, Q&A?
No, I think this was, I just want to be mindful of time. I think this was the last question. If we didn't answer, there's a few questions that weren't answered. We'll answer them over email, so I apologize in advance if we didn't. I'm happy about the last question because I do think that long term, we're going to see people back in offices. And remember that right now, the new normal is not to be in the office. But when the new normal is everybody's going to be in the office, no pandemic, no masks, I think that at some point, you'll see that back. And I think people will be happy to be back and socialize again. But Mayor, I wanted to thank you for hosting with us. I want to thank Eitan, Jim, and Rick. Thank you so much for being here. I want to thank James O'Neill. If you have the opportunity, please check out Legal Outreach. And I want to thank my colleagues at Ariel Property Advisors for putting this great event and presentation together for us. Thank you very much. And if we haven't answered your questions, we will over email.
Thank you, Shimon. Thank you, Mayor.
Thank you.
Thanks, guys.
Thank you, guys.